Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're here with me today. We are going to continue our conversation that we started a couple weeks ago about passive investing lingo. So today we're going to cover the passive investing 201 level lingo, and we're going to focus mostly on the math. Now, if you are wondering, hey, where is the 101 lingo? You can find that on our YouTube page. There is a recording there. So make sure that you've watched that video first, or at least go back and watch that video, because these two videos stack on top of each other. Excuse me, I got a tickle in my throat. But if this is the first time that we're meeting, again, welcome to the Passive Investing Made Simple show. My name is Whitney Elkins-Hutten, and this is the whole reason why I invest in real estate, and primarily in passive real estate. So I can spend time with my crazy crew here and travel the United States, travel the world, spend time with them. We work and play from the road, but this is the whole reason why I do it. I started investing back in 2002. I, as a live-in flipper and house hacker, and then eventually came to the realization, hey, I can't create cash flow this way. I can't unlock those golden handcuffs from my job. So decided to start scaling in single-family rentals, got to 36 units, and then had a realization. I'm like, wait a second, I need to go bigger if I want to go faster. So transitioned into multifamily real estate. And then I hit another inflection point, was like, how can I invest in other people's deals and help them grow my portfolio? Sure enough, there was a strategy called passive investing that allowed me to do just that. It also allowed me to diversify my portfolio across other asset classes, like car washes, like real estate debt, like self-storage, things that I knew that I didn't need to figure out how to do. That way I could stay focused on what it is that I did best in real estate, which was residential real estate. Fast forward to today, my husband and I combined together, we have over 6,500 residential units, over 2,200 self-storage units, and over 15 express car washes in our portfolio, and a myriad of other assets. But if you're like me, why you're here is not for the numbers, but for this number right here, is that you have 100% control and choice on how you spend your time, right? There's the 5 freedoms in life. That is what we are after as passive investors, not just financial freedom. Financial freedom is kind of like tier 1, okay? It's when we hit financial freedom, what can we now do? Or what can we now do on that journey there? Well, we get freedom of choice, we get freedom on how we spend our time, we get freedom of location, and freedom in how we are going to create impact in the world. And that's what I love doing here with you guys at PassiveInvesting.com. We have over $308 million lent through our Rehab Wallet debt fund portfolio. And if you're listening to this in July of 2024, reach out to me. We have some very interesting bonus terms on our debt fund. You can reach out to me at whitney@passiveinvesting.com. And then we also have the equity side of our portfolio too, combined total assets under management there of 1.4 billion. So, all right, now today I want to make sure we leave plenty of time for our topic, because we're kind of, like I said, this is a 2-part series. We've done the 101 lingo, okay, the base lingo, like what is a syndication, who is an operator, who is the limited partner investor, what does it mean to be accredited? Okay, now we can certainly recap any of those terms in the Ask Me Anything part of the show, but I really encourage you, go back to our YouTube page, look at that previous video, because these two videos combined together are really to help you bolster your education as a passive investor. But also, if you're new to passive investing, these are the things that you need to know before you get into a deal. Now, we are going to go over some math today. So what we're talking about today is not financial advice, legal advice, or tax advice. So make sure if there's anything construed like that, that you take it back to your investment team before making a decision in a deal. Now, let's talk about, I want to make sure we break down our math into certain categories. And the first category I'm going to actually talk about is actual returns on a deal. because limited partner investors, I've coached several, I've also, partnered with several limited partner investors. Sometimes they get a little confused and they start quoting back to me. They're excited about certain terms that they see in a deal, but they're quoting back to me hurdles for the operator to meet, not the actual returns that are projected on the deal. So let's break these categories apart. And the first one we're going to take a look at is actual returns. So where are we going to find the returns? Well, first we need to locate the offering memorandum. Okay, so this is a document. It's usually a nice, pretty, shiny PDF packet, or maybe even a printed packet that states the objectives, the risk, and returns on a particular investment. Okay, now it's also going to have financial numbers in it, like what we call the Proforma, forward-looking projections. It also should have what we call trailing numbers, trailing 3 months or trailing 12 months. Okay, like if this property is being purchased, what did it used to do? How did it used to perform with the previous owner? Those are called trailing numbers. All right, so Proforma is forward-looking, trailing is backward-looking. It should also have the biographies of all of the general partners and co-general partners in the deal. And it should list out the business plan. Okay, with the purchase of this asset or the investment in this asset, what is your money going to? Okay, what is it going to be used for? What is the business plan? What are you partnering on? And there's a ton more data in here. But it's not to be confused with the legal side of things, known as the private placement memorandum. Okay, the offering memorandum is more like a marketing document, if anything. All right. The next term that we need to understand here is, and this is all kind of leading into the return side of things, is the capital stack. All right. So the capital stack is also telling us the different layers of money in a deal. Okay, it doesn't tell us who gets paid what and when, but just the different layers of money that go into a deal. Each layer of money is going to have their own projected returns. So our debt, okay, kind of like the bank debt, or even a second loan on a property or a mezzanine debt. These are on the debt side of things. Okay, they're not going to share in the upside of the deal. They're taking the lowest position in the capital stack, and they're going to get a pretty low return. But that's what they want. They want the security of being first in line to get their money back upon exit. And then we flip into the equity classes, like preferred equity, like common equity. And as we kind of scale up this ladder, the higher returns tend to go to the people in the capital stack that are taking higher risk. Now, the different layers of the capital stack are going to be found in two places. They're going to be found in the offering memorandum as well as the private placement memorandum. Okay. Now, it was really important for us to kind of tell you where to find these numbers and like what numbers, especially the returns, are based off of. Okay, the returns tend to be tied to what level of risk you are taking in a deal. Now, the first return that you should be paying attention to is actually the cash on cash return, or you might see it noted in the offering memorandum called COC. And this is a ratio that compares the annual pre-tax cash flow from a property to the total amount of cash invested in it, okay? And it's calculated after the debt. So, whatever income is coming in, you back out the, all of the expenses, including the debt, what's left over, you're going to divide that by your actual invested dollars in the deal. That gives you your cash on cash, all right? So this is a great number because this actually gives us a clue of the cash flow. Now, a lot of limited partner investors, they look at cash on cash, but they confuse it with a preferred return. And we'll talk about what a preferred return actually is here in a second. But if you're looking for how is that asset going to put money in my pocket year over year, look for this number, cash on cash. All right. Now, here's another, we're going to kind of level up our knowledge here, capitalization rate. Now, capitalization rate is, is actually, or can be calculated as return itself, okay? But moreover, most properties that are being purchased are going to have debt on them. Okay, so we need to, capitalization rate is actually assumes what is the estimated potential return on an investment property. Okay, and it's calculated as the net operating income divided by the current property market value of the asset. Okay, so essentially, it would give you the rate of return on a property. Okay, it would be the cash on cash return should that property be bought all in cash, assuming there was no debt on the property. Now, most operators are leveraging other people's money, like bank money, other type of private investment, in order to amplify the return, okay, in order to make what we call a levered return. Okay, but this is what a capitalization rate is. The cap rate formula, net operating income divided by the current market value of the asset. Okay, so if we're looking at multifamily properties, depending on the market, depending on the class of the asset, if it's A class, B class, C class property, we might, in a certain market, you might see a capitalization rate of, say, 4%. Now that you'd be like, oh, I don't want to invest in a property that has only a 4% capitalization rate or a 3.5% capitalization rate. But that is, if the property were owned all in cash, that would be the return that it gives you. Okay, so now let's talk about projected returns. Okay, so this is where we got to go and look at what we call a pro forma. Okay, forward-looking numbers. Now, I just pulled this example off the internet, but a pro forma is a financial projection of a real estate property's income, expenses, and profitability over a set period of time. It can be used to evaluate a property's performance and predict future cash flows. Now, here's the key thing. It is a prediction of future cash flows. So this is where we have to have extreme caution and care that we are partnering with an operator that is doing all of the due diligence of how that market's going to perform, how that asset class is going to perform in that market. Are they doing all the research on the various expenses that are going to go into that asset? Are they doing all the research on the different vacancy rates and how well they can increase the income? Because all of these assumptions go into generating a pro forma. All right. Okay. So here's a little exercise. Like I said, we already defined what a cash on cash is, but I want to show you where to find it, because just looking at the pro forma, if I go back here, we see our cash flow here at the bottom of the pro forma, or our profit, but we don't know what the cash on cash is. And so usually you're going to see this type of grid in your offering memorandum that will help you understand year over year how the cash flow on that asset may or may not grow, okay, depending on what's happening. Okay, now let's talk about internal rate of return. Internal rate of return, I know a lot of limited partners, they're just like, hey, I want an IRR of 15, 17, 18%. Help me figure out from this table right here how to calculate an internal rate of return. Well, it's not that simple. It is a calculus formula, but let me demystify what the difference between internal rate of return and annualized rate of return is. The internal rate of return is the return that would make the present value of future cash flows plus the final market value of an investment opportunity equal to the current market price of the investment opportunity. So it's that rate of return. So essentially, it's taking into account time. What is the value of that property? What is the rate of return over time, assuming that you're going to get your capital returned to you? That's the assumption that's being made here. So the higher a project's internal rate of return, the more desirable potentially that project is to undertake, right? Now, here's the thing. All these things here are inputs, they're assumptions, because notice the internal rate of return is predicated on the cash flow over time on an asset. Okay, that cash flow comes from our pro forma, which comes from assumptions, right? So kind of like a running joke that a lot of like high level investors have, or like, how many times is a pro forma right? And it's almost never, because it's always going to be off, right? Because you have all these assumptions that are coming into the Proforma. So the Proforma is always going to be off because there's just so many inputs coming in here. So that's why when you're looking at a deal, you're generally going to see an internal rate of return range, okay? And we'll talk about how this range is important here in just a minute. Now, I said that internal rate of return is different from annualized rate of return. Well, annualized rate of return isn't calculated on like when you get your capital returned to you. The annualized rate of return actually has that, calculated, baked into it. So there's a couple of different ways you can look at annualized rate of return. Okay, you have the investor annualized annual return, excluding disposition. That's the average return per year during the investment hold period. Okay, it does not include return of invested capital. And then you have what we call the investor average annual return, including disposition, and the average return per year, including profits from the disposition. Okay, so my suggestion is if you're comparing multiple projects, okay, the internal rate of return, because it accounts for when your capital is returned, this might be a better metric to kind of compare apples to apples. However, if you have a project that is an infinite hold type project, internal rate of return doesn't matter. All right, now we got equity multiple. So equity multiple is usually something a little easier for people to wrap their heads around. This is also a return, a projected return. Okay, and this is the total cash distributions received from an investment divided by the total equity invested. Okay, so essentially, how much money an investor can make on their initial investment. Here's the thing, you don't want to just compare equity multiple numbers project to project because you want to know the time. I can say I can 2x your money on an investment, and you go, yes, I love that. I want it in. Do you? Because am I going to 2x your money in 5 years, 7 years, 10 years, 30 years? Right? So we always want to anchor that around time. Okay. So what we talked about are current returns on the project, or projected calculated returns. Now let's talk about hurdles. Okay. So hurdles are a little bit different. These are going to be attached to what we called our waterfall. Okay, last time we met, and our waterfall essentially gets to tell us when do all the different levels of partners get to start partaking in splits on the deal. Okay, so the waterfall essentially determines who gets paid what and when, right? And the waterfall might be indicated in the offering memorandum, but it definitely should be outlined in the private placement memorandum package. All right, so the first kind of step or hurdle in a waterfall, if it's there, not all operators will put in a preferred return, but a preferred return generally is the first hurdle for an operator to clear so they can start, participating in returns or splits on the deal. But a preferred return, again, people get confused. This is not confused with cash on cash. A preferred return is a hurdle, essentially a minimum rate of return or threshold that an investment must reach before incentives are paid out. It's also known as a hurdle rate or a required rate of return. So as we see here under investor distribution and cash flow in our example, what's highlighted is 7% preferred return. That means this was taken from one of our deals. That means our investors are going to get the first 7% of any deal, of this particular deal, before the general partner in the common equity class starts taking any split on the cash flow. Okay, so that's really key. Now, I have a little asterisk here. It says, watch for GP catch-ups, because what comes next, how people the waterfall can be manipulated, and like GP catch-ups, general partner catch-ups, you want to make sure that those are not in a deal, because it really can put you in the operator not aligned in a deal. Okay, so typically a GP catch-up would start impacting on when the general partner gets to take their split. So let's talk about that. A general partner split is the percentage of partners that a general partner is entitled to earn okay? Incentive fee, also known as carried interest, and is often negotiated because the general partner takes on additional work, such as finding, vetting, managing, overseeing the investment. Okay, so that's why us as limited partners get into this to begin with, is because we have money and we want our time and we want to have the diversification in our portfolio, and the general partner is willing to do all the work. So that's how we're splitting on the deal. So general partners, as you can see here in under investor distribution and cash flow, that second line here, now once the 7% preferred return hurdle is cleared, now the general partner is starting to participate in splits. Okay. Now there can be splits on cash flow. There can be splits on the sale of the property. Okay. And there can be splits in both areas. Okay. So it can really, the waterfall can get really complicated, or it can stay really simple. But oftentimes what I see in larger syndicated assets is that there will be another hurdle. So there would be a preferred return hurdle and then another internal rate of return hurdle. So, and that's what we see here in the second box. All right. Now, sensitivity analysis. Okay. So we talked about all the different inputs that go into these calculations and how they're pro forma as an educated best guess on the performance of a property. How do you, as the limited partner investor, now take that information and determine, okay, looking at the pro forma and the occupancy percentage and the expense increases and all this stuff, how do I know what is a possible range of returns here on a particular asset? Well, this is where we get into what we call our sensitivity analysis. It's a method in taking into account several factors that impacted an investment property return and helps you calculate how a change in each factor would affect profits. In this particular sensitivity analysis, we're looking at the cap rate. Okay, the cap rate, remember, was if we bought that property all in cash, no debt on the property, that is what the cash flow would be on a property. Okay. But we didn't. We used leverage, okay? But cap rates change, right? Because it is based on the current market value of the asset. So cap rates, if they're starting to compress, that means the market value of the asset is getting higher, it's growing, okay? If cap rates are expanding or getting larger, that means the market value of the asset is decreasing, going down. So if this is how assets trade in the market based on a cap rate, we want to know if this cap rate starts moving around in a market for a particular asset class, how is that going to impact my IRR that I could expect to receive, my equity multiple, and the cash on cash of the property. Okay, so that's sensitivity analysis. There's two things here. One, note that it too is based on an operator doing great pro forma research. Okay, great pro forma research. And number two, it is, again, it's a best guess. So we want to see a range of this cap rate. Okay. In this particular asset, we entered the market at 4.2% on this asset. Of course, if the cap rate went down, that meant the market's getting better. We all want that. But what happens if the cap rate went the other direction? Okay, what does that do to the returns on the asset? As I educate my limited partner investors, when you go on a deal, look at the entire range of the sensitivity, okay, and make sure that the operator is doing good math. All right, guys, that was a lot to digest today, but that was all kind of like the math lingo that I think limited partner investors should know before they go into their first or next deal. If you are interested in learning more or connecting with me directly, be sure to reach out to me at passiveinvestingwithwhitney.com. There you can see our open deals, jump on a one-on-one call with me. We can talk about your goals around passive investing, and you can get access to additional classes like this. Guys, if you're here live, don't go anywhere. We're about to have our Ask Me Anything session. Easy for me to say today. Sorry, guys. All right. Oh, Chris said thank you. Absolutely. My pleasure. Well, this is a great time. If you guys have questions on anything that we covered today, also a couple weeks ago when we talked about the initial like terms that limited partners should know before they go into deal. Yeah, now's the time. Go over to your Q&A box. That's the easiest way for me to kind of queue things up, and we'll get those questions answered. Aw, thank you. Frenchie said, excellent presentation. Thanks. All right, guys, I'll hang out here for a couple more minutes. Sure, certainly you guys have some questions. But if not, I'll give you guys some time back on your day, but go to that Q&A box and let me know. Let's see here. Oh, and somebody said I have to run. No problem. No problem. In process of contributing, oh, somebody was just said, another person said, great job. Okay, perfect. And they're in process of connecting to our rehab wallet deal. Yeah, and like I said at the beginning of the presentation, if you are looking for a debt position, whether it is a short-term, more liquid type debt position, or if you're looking for something that's more long-term and it has a compounding effect to it, we actually have an incentive right now, investor incentive, because right now we have so many loans that we could fund. Okay. I mean, great loans that we could fund, but we want to make sure that our investors are ready and poised to be able to take advantage of this environment. So we are having an additional incentive. If you are interested in that, you can reach out to me directly at whitney@passiveinvesting.com. And it's only for the month of July. So we've got 22 days to get you guys in that deal. All right. Well, I know it is the first day back after a holiday, for some people, a holiday week. If you guys have any questions, feel free to reach out to me directly, Whitney@passiveinvesting.com, and we'll see you. Actually, we have a boot camp tomorrow with Nikki Miller of The One Thing, Jay Papazan and Gary Keller's group. She'll be with us and helping us do a mid-year reset for our goals and vision. Otherwise, we will see you next week. All right, everybody, take care.